A comprehensive look at trends, fund profiles, and more in Exploring ETFs.
If you are thinking about hedging your portfolio risk using ETFs, well, you've come to the right place, because that's exactly what we're going to be talking with our ETF Research Director, Nina Mishra, about in this segment. And it does make sense given all the volatility in the market, right?
Yeah, market is so volatile now, and it may continue to remain volatile. And yield curve inversion is the latest risk. Yield curve inversion worsens since yesterday and reached its worst level since 2007 because nervous investors, they continue to pile into safer government long-dated bonds.
And the curve goes back and forth almost intraday anymore.
Yes.
From inverted to not inverted, maybe 2-3 times in a day.
So 3 months to 10 year has been inverted for almost 2 months now, and it's 2 years to 10 years, which is causing a lot of worry and a lot of problem, because that is seen as a reliable recession indicator.
Yes.
And reasons behind this inversion are not difficult to understand. Investors are worried about trade tensions and global growth slowdown resulting from trade tensions, and geopolitical risks are rising in the Middle East, North Korea's saber rattling, and tensions between Japan and South Korea. So there are so many reasons to worry about, and earnings season was not great.
Not the least of which, right.
To add to all those worries. So it makes sense to look at ETFs that provides some protection against market downturns, while some upside potential if the market goes up. And U.S. equities, some of the companies have been doing pretty well because U.S. economy, unlike other economies, continues to be on a solid footing.
Sure.
So these ETFs want to provide some upside potential and seek to hedge risk against downturns.
All right, well, let's have a look here at a couple of examples. One is the Amplify Black Swan Growth and Treasury Core ETF. Swan is the ticker.
Very appropriate ticker. It seeks to provide protection against black swan events. So what it holds is about 90% of the portfolio is invested in long-dated treasury bonds, and about 10% of the portfolio is invested in S&P 500 in the money leap call options.
Okay.
So it seeks to provide exposure to S&P 500 gains, and those leap options will provide about 70% of S&P 500's upside. Those leap options could lose all their value if the market goes down 10% or more.
Okay.
But when the equity market goes down, bonds usually gain,
Yes.
especially government bonds.
Right.
So that is why that 90% of the portfolio which is invested in government bonds will outperform when the equity market goes down. Pretty reasonable for this kind of unique specialized strategy. 49 basis points expense ratio, and it launched in November last year, which was a very timely launch because December was so volatile, and because of its unique strategy, it has already attracted more than 100 million in assets since its launch. Now, if you want to learn more about this ETF, you can go to the quote page on Zacks.com. There was a podcast I did with the ETF provider. You can listen to the podcast, read the article. You can also go to the external home page using the link on the quote page and learn more about this ETF. And as I mentioned, if you look at the holdings, 90% of the portfolio would be in U.S. Treasury bonds and 10% in those leap options, which will provide about 70% of the upside.
All right, and then there's also a U.S. market neutral anti-beta fund you want to tell us about.
The ticker is BTAL. So this is kind of market neutral. So returns are kind of uncorrelated with the broader market, but they are dependent on the spread between low beta and high beta stocks. So it is long low beta stocks, short high beta stocks. And it is not only market neutral, it is also kind of sector neutral because that long short strategy applies to each sector. Little bit pricey because shorting is not cheap. So because of the long short strategy, it charges 76 basis points. It also has decent amount of assets, 90 million under management so far. So again, if you want to look at this ETF, you can go to the quote page, and from there, the external home page of this ETF. This was earlier called Conscious, now it is AGFIQ. So you will see that in each of the sectors, the ETF has almost equal long and short positions. That is why it is sector neutral. About 200 companies long and about 200 companies short. Now the long, as I mentioned, long companies are high beta companies, and long companies are low beta companies, and short companies are high beta companies. So when the market is very volatile or when the market takes a downturn, then usually high beta stocks sell off more than low beta stocks. That is how this ETF will outperform in a volatile market environment or when the market goes down. It is because high beta stocks will go down more than the low beta stocks.
Okay. And the long and short of it for this conversation lies in the comparative performance.
Yes, so I have 3 comparative performance charts because I wanted to show that these ETFs will perform differently in different kind of market environments. They will tend to outperform when the market is very volatile, but they will kind of lag behind the broader market when the market is very bullish, when the market is going up. Now the first one is since 6th November, and I chose 6th November because Swan has been around since 6th November, so that is why it made sense to choose that period. And S&P 500 took a dive in December, and if you look at this chart, you can see that both these ETFs, Swan and BTAL, both have outperformed the S&P 500 index significantly since Swan's inception. Now on this chart, I have the year-to-date performance. So you will see that BTAL has slightly lagged behind the other two. Swan continued to do well this year because this was an unusual year when stocks were rising, treasuries were rising too. Usually they have a negative correlation, but this year we saw that most of the time, both treasury bonds and stocks were moving together because investors were still putting a lot of money in treasury bonds. So Swan and S&P 500 have almost similar return. BTAL slightly lagging behind in the year-to-date time frame. Now on this slide, I have the 3 months performance because this is the period when market has been really volatile, and you can see that the 2 ETFs that we discussed today have done really well compared to the broader market. BTAL is up almost 10%, Swan also 7.5%, whereas the S&P 500 is up about 2.5% during this time period.
All right, very interesting. Do you own either of these two?
No, not yet.
All right. But you're looking at
Yes,
it, right?
yes.
Okay. Thank you for that, and don't forget there's always more ETF information. That's on the ETF portion of Zacks.com, our website. Use the Funds tab in the top toolbar on the home page to help guide you there. Also, as Nina mentioned a while ago, don't forget about her ETF Spotlight podcast, where she spotlights a lot of interesting information on ETFs that we don't have time to discuss in these video segments. All you need to do to get there is stay on the home page, go all the way to the bottom, and click on the word podcast, and it'll help take you to that section of our site. With Nina, I'm Terry Ruffalo.